Okay everyone, Assalamu alaikum and welcome to ACCA revision session for paper F7 financial reporting, and today is day 3, 15th November 2017. Let's start today's session. In day 1 we have covered the tangible non-current assets, which covers IAS 16, IAS 40, IAS 23. In day 2 we have covered financial instruments, IFRS 9. And in day 3, we have covered a lot of different accounting standards, including IAS 12, revenue recognition, IFRS 15, leasing, IFRS 16, intangible 38, impairment 36, and non-current assets, IFRS 5. IAS 20 was to be solved by you people on your own. I hope you people have covered it. And in today's session, day 3, we are going to solve 3 different past papers questions of final accounts by the name of Triage, Extol, and Downing. So these are the 3 areas that we are going to cover in today's session. Walaikum Assalam, Arslan Beg. So let's start solving the questions. And we are going to start with September 2016 question by the name of Triage. And I'm going to solve the question in the CB format, CB pattern, so that majority of you people will be attempting the exam in the manual format. So you will be solving on your own in the manual format. But I'm solving in the CB format so that if in any case any of you are unable to pass in December 2017, then in March 2018 CB is going to be compulsory in Pakistan. So that's why I'm going to solve these questions in CB format, so that you people are also aware of how the changes are going to be implemented in ACCA. If you people have any questions, you can meanwhile post them on the question box. Okay, so here's the question by the name of Triage. Let's start the question. Are you all people with me? Are you all people with me? Okay, Arslan Beg is with me, Lee is with me. Okay, a lot of yes. That's good. So let's start. And I'm going to read the question. You people already have the question, so you can refer to that. I hope my screen is easily readable for you people. I hope my screen is easily readable for you people. Okay, that's good. So I'm starting to read the question. The question says, after preparing a draft statement of profit or loss before interest and tax for the year ended 31st March 2026, before any adjustment which may be required by note number 1 to 4 below, the summarized trial balance of Triage company as at 31st March 2026 is. So the question has given us the trial balance before any adjustments, but the question has also shown us the profit or loss, which is profit before interest and tax in this. So what is the requirement? I'm reading out the requirement. The question says that prepare a schedule of adjustments required to the draft profit before interest and tax in the above trial balance to give the profit or loss of Triage company for the year ended 31st March 2026 as a result of the information in notes 1 to 4 above. So if I use a scratch pad, what is the question requirement? To calculate the adjusted profit or loss. Now let's read out the second requirement that the question wants from us. Prepare the statement of financial position of Triage company as at 31st March 2026. So we also need to prepare the financial position. So I'm writing, I have to prepare the financial position. And there is another requirement. The issue of convertible loan notes can potentially dilute the basic earnings per share. Calculate the diluted earnings per share for Triage company. For the year ended 31st March 2026, there is no need to calculate the basic earnings per share. So the third requirement is actually to calculate the diluted EPS. So I'm using the scratch pad to note down what exactly question requires from me, because obviously I cannot write anything on the question. If you're doing a manual paper, obviously you can write on the question paper, but in CB format, you cannot write on the question paper. So anything that you normally write on the question paper can be written on the scratch pad. The scratch pad cannot be viewed by the examiner. So make sure anything that you're writing on the scratch pad will not be transferred to the examiner. And then there's a note, a statement of change in equity and note to the to the statement of financial position are not required. So there's no need of preparing statement of change in equity or the notes. The following marks allocation is provided in guidance for the question. Part A is of 5 marks, part B is of 12 marks, and part C is of 3 marks, and the total marks is 20, and we are going to solve this question on a spreadsheet question. So what practice can we make for a spreadsheet question is that I'm leaving 4 lines for the working, for the correction of profit, and then I will be using this area for writing down the adjustments. And then again I'm allocating 4 cells for this, and then I'm moving 1 cell short, and I will be showing all of my workings over here. So this is going to be the adjusted profit or loss, and then adjustments, and then I'm going to show the workings to the examiner. Now let's have an overview of the trial balance, just to have a look of what information has been provided. So the question is given as equity shares of $1 each. The question is given as the retained earnings as at 1st April 20x5, which means these are the retained earnings opening. The question is given as the draft profit before interest and tax for the year, and which is, if I slide down the screen, the draft profit is actually 30,000. And then the question is given as 6% convertible loan notes relating to adjustment number 1, $40,000. Lease property having the original life of 25 years, and at cost means that the property has not been revalued previously. So the property cost is 75,000, plant and equipment cost is 72,100, accumulated depreciation is 15,000, lease property has been depreciated by 15, and the plant has been depreciated by 28,100, receivables are 28,000, other current assets are 9,300, current liabilities are 17,700, current liabilities are okay, this is deferred tax is 3,200, interest payment is 2,400, and the current tax is 700. So this is the trial balance given by the question. And if I look down towards the adjustments, I can find 4 different adjustments in the question. So normally in a final accounts question of 20 marks, you are going to find 4 adjustments. But previously, when the final accounts question used to be of 25 marks, at that point of time, there were 5 adjustments. So now you should expect 4 adjustments in the exam. So I'm starting from adjustment number 1, where the question says that Triage company issued $400,000, $100, 6% convertible loan notes on 1st April 20x5. So 1st April 20x5 means at the start of the year, on the first date of the year. Interest is payable annually in arrears on 31st March each year. So the interest will be paid at the end of each year. And then the question further says the loans can be converted to equity shares on the basis of 20 shares for each $100 loan note on 31st March 20x8, which means the loan note belongs to 3 years. Issued in 20x5, so 20x6, 20x7, and 20x8. The total life is of 3 years. Or redeemed at par for cash on the same date, or this can be redeemed at par. An equivalent loan note without the conversion rights would have required an interest rate of 8%. So 8% is actually the market rate or the effective rate. So we will be using this to calculate the present value. The question further says that the present value of $1 receivable at end of each year based on discount rates of 6% and 8% are. Now the question is given as the discount factors. So if we start calculating this adjustment, I've moved on towards the workings. I've converted it into bold using Control B shortcut key. Now, the first step is normally to calculate the present value of all future cash flows. If I just write down over here to explain you people that in case of a convertible loan notes, what is the accounting treatment? That convertible loan notes are normally a compound financial instrument. So if these are a compound financial instrument, this would have both liability and equity component. So both should be recorded separately, liability separately, equity separately. Okay, so financial liability is calculated as the present value of all future cash flows, and equity becomes the balancing figure. So this is how we calculate both the components, and then we prepare the table. As the year, brought down, interest expense, interest paid, amortization, and carried down. So this is the way we calculate the compound financial instrument adjustment. So if I start solving this, I'm writing here cash flow, discount factor, and the present value. So it's year 1, year 2, and year 3. The cash flow is going to be 40,000. The actual amount of the loan notes is 40 million, 400,000 and 200, 40 million. But we are performing all of the calculation in thousands. So 40,000 multiplied by the 6% rate, which is the coupon rate. So 40,000 into 6% will give us the interest cost of 2,400, which is going to be the same in year 2. And again in year 3, the interest is going to be the same, plus we are also going to repay the loan at par in year 3. So I'm adding 40,000 in this. So the cash flows I've got is 2,400, 2,400, and 42,400. And I'm going to use these discount factors, 8%, because this is the market rate. So I can even write over here bracket. I'm using 8% discount factor. So this is going to be 0.93, 0.86, and 0.79. I'm using the factors given in the question, these three. And if the factors are already given in the question, it's better not to recalculate them and use those values directly. So now I'm multiplying 2,400 equals to, we'll start the calculator in the spreadsheet. 2,400, I'm using the arrow key to move left, multiplied by 0.93. Again, I have used the left arrow key. So this will give the present value, and if I copy this using a shortcut key of Control C and paste it, it will automatically be applied on year 2 as well. Similarly, I'm going to paste it again in year 3. So I've got all of the 3 values. And now I'm applying a formula equals to sum, and I want to sum all these 3. So I've selected these 3, and if I press the enter key, this is going to tell me the exact value of the liability. So this is the present value of all future cash flows. Ahmed Junaid is saying it should be 402,400. Yes, Lee, I'm working in thousands. All of the workings are in thousands. Actually, Ahmed, the total loan notes are 400,000 in quantity into 100. So if I show you, equals to 400,000 into 100 is the total amount of the loan. But because I'm performing the calculation in thousands, I'm going to divide this by 1,000, and the answer is 40,000. So the amount of the convertible loan notes is actually $40,000. It's not 400,000. 400,000 is the quantum. This is the quantity. Maz is asking, sir, discount factor. Maz, I've used the discount factors from over here, 0.93, 0.86, and 0.79. I've just pasted them over here. Okay, so this means that the liability, the financial liability component is, I'm writing down over here, is 37792 and the remaining value is going to be equity. So if I write equals to, we'll start the calculator, 40,000 minus 37792 is going to give me the amount of the equity. And if I want to apply the formatting on this, which is not necessary, I can simply go over here and I can select this to be shown in decimals either, or the comma separated values, and the comma separated and the decimal values. All options are there. I'm using this comma separated values. So now the commas have been there. So the liability component is 37792 and equity is 22208. Mas, the rate I have used 8% because this is the market rate, which is the rate of the equivalent loan notes without the conversion rights. The discount factor is always the rate of equivalent loan notes without the conversion rights, so that the liability component can be calculated. So actually this is a compound instrument. This is a compound instrument which includes liability, equity both. So I have actually removed the equity so that the liability shall be there. Hamza Ahmed is asking how 2400. Hamza Ahmed, here's the formula. 40,000 of the loan notes multiplied by 6% of the coupon rate. The interest payment is going to be at 6% and the market rate is going to be 8%. So discount factor used will be 8% and the cash flows calculated will be using according to the 6%. Clear, Hamza Ahmed? The discount factor will always be the rate of without conversion options, and the cash flows will be the rate given in the question. So now we have calculated the liability and the equity component. Now I'm going to calculate. Okay, Hamza Ali is asking how 40,000. Hamza Ali, there are two ways. You can simply go and see the amount of the loan notes in the trial balance. It's 40,000. Or the second option is the quantity of loan notes was 400,000 and the discount factor and the par value is 100. So this will become 400,000 into 100. This is the amount of the loan notes. And I'm dividing this by 1,000 because I'm calculating all amounts in thousands. So this is going to be $40,000. This is how we have calculated 40,000. Okay, now next step is to calculate the amortization table. Welcome, Hamza Ali. So I'm writing year brought down, interest expense, interest paid, amortization, and carried down. Now if you see, my values are not being shown properly. Interest expense, interest paid, amortization, they are shown partly but not completely. So you don't have to worry for this. There are no marks for formatting. The examiner will read each and every cell of yours, that what amount or what value or what particulars have you written. So there is no need of formatting. You just need to show the examiner your calculations. So I'm calculating year 1 where the brought down of liability is 37792 and I'm going to apply interest rate of 8% on this. 37792 into 8% is 3023.36 and the amount of interest paid in year 1 would be 2400, the cash flow of year 1, and the difference is going to be the amortization 3023.36 minus 2400. Now all of my linking, that what value is being calculated how, is being shown to the examiner. In a paper-based exam, examiner cannot know the value, how you have calculated the value. So if you are using a unique method, a new method, one of your own method, then the examiner would get confused that how this value has been calculated. So the benefit of Excel is that it is going to show all of the workings automatically. Now the carried down is going to be brought down plus the amount of amortization. So this is going to be the brought down, and I'm rounding off all these values. So the answer is 38415. Now even if the examiner wants to see this onto 2 decimal places, the examiner will go and select 2 decimal places. So there is no need of rounding off actually. We are performing all rounded off values and the actual values are also there. So these are some of the benefits of spreadsheets, and practically also we use the spreadsheets. So this is more close to the real exam, to the real environment. Now this is my working. Now what entry am I going to post? If I move towards the adjustment, I'm writing down adjustment number 1 so that the examiner knows what exact adjustment I'm recording. And if I see in the question, the convertible loan notes are recorded at complete $40,000, and the question has not recorded the equity component. So I'm preparing an entry. I'm going to debit 6% loan notes, or I would say 6% convertible loan notes. And I'm going to credit equity option. Why am I crediting the equity options? Because actually the equity option was to be recorded at its value of 2208. So I will be debiting the loan notes and crediting the equity option by 2208. So this is the first adjustment that was to be recorded. We have to decrease the loan notes from 40,000 to the value of the financial liability, and instead we have increased the equity option. Any confusion with this entry? You people can ask, because this is something new to you people, the CB format, which is going to be mandatory after December. So it is very necessary to learn all these impacts, how to show the workings, how to record the transaction, how to prepare the double entry. Okay, that's good. There are no confusions. Talal Hassan wants me to repeat the entry. Talal, the entry that I've recorded is actually the convertible loan notes were recorded by the examiner at 40,000. But according to our working, the loan note should be at 37792. So we should reduce the liability by 2208. So I've debited the liability and I've recorded the same 2208 as a part of equity, because this is the equity component. So we have actually divided the 40,000 between liability and equity, 37792 liability and 2208 equity. Now the second entry is going to be to record the interest. Welcome, Talal. So the entry is going to be finance cost debit. Finance cost debit. The interest, some of the interest we have already paid. This one, interest payment of 2,400, and the remaining interest will be paid at the time of redemption. So we are writing 6% loan notes credit. 6% loan notes or 6% convertible loan notes, it is the same thing. We can use them interchangeably. Yes, Nazia, 6% convertible loan notes debit means liability debit, because we are going to write these loan notes in the liability area of the balance sheet. Mohammed Nabil is asking, so we took difference of 6 and 8%, because Nabil, the cash that we are paying is 6. The cash that we are paying is 6, and the amount that should have been paid was 8. The amount that should have been paid was 8, but we are paying 6. So what about the difference? Are we not going to pay the difference? We are going to pay the difference, but at the time of redemption. So that's why we have increased the liability by the difference, because we are paying 6, but we should have paid 8. So the difference of 2 will increase my liability, which I am going to pay at the time of redemption, at the time of settlement, at the end of the year 3. So finance cost debit is going to be by the amount of interest expense that we have calculated, 3023. The interest paid is 2,400, and the difference is going to be the increase in the liability, which is 626.36. And if I want these values to be rounded off, I can select all the values all together and can simply click on the option. So all of these values will automatically be converted into comma separated values. So this is the adjustment number 1. Now we have completed it. If you people have any questions with respect to adjustment 1, you can ask. Sayyid Maz is asking why we have computed interest expense on 8. Maz, actually the interest that should have been paid is 8. So we are also paying 8. We are also paying 8, but at the time of redemption. The differential is going to be paid at the time of redemption. So the cash we are giving is 6, but the amount that we are effectively paying them is 8. Because the differential value is going to be paid at the time of settlement, at the time of redemption. So that is how we have completed the adjustment number 1. All questions can be asked right now. Yes, Hamza, we can use the name financial liability instead of 6% loan notes. There is no harm. Smitha is asking, so the finance cost goes in the statement of financial position as a current liability? No, Smitha. This is the amount that we are going to pay at the time of redemption. The amount of amortization, which is 623, is the amount that we are going to pay at the time of redemption. So this is a non-current liability. No, Nazia, 6% loan notes is a non-current liability because total life of the loan notes was 3 years and 1 year has passed by. Total was 3 years, 1 year has passed by. So the liability will be paid after 2 years. So that's why it is a non-current liability. If, for example, the total life was 3, but 2 years would have passed, in that case, the loan notes would have been treated as a current liability. But out of 3, only 1 year has passed. That is why it is a non-current liability. Yes, Junaid, exactly. You are right. The liability is the same that we have calculated. Okay, now we are moving towards the adjustment number 2 now. The adjustment 2 says that the directors decided to revalue the lease property at $66.3 million on 1st October 20x5. 1st October 20x5, which is this date? Start of the year, end of the year, or mid of the year? 1st October 20x5, which is the date? Start of the year, end of the year, or mid of the year? Yes, Nazia, Lee, you people are right. This is mid of the year. So what exactly we are going to do, if I move on towards the note, so we are actually revaluing the asset in the mid of the year. So what will we do is that first we are going to depreciate for the first 6 months, and then we are going to revalue, and then we are going to depreciate for the next 6 months again. So first we have to depreciate for 6 months, then revalue, then and again depreciate for 6 months. So I'm moving towards my working side, and I'm going to write that the net book value of the property, if I move towards the trial balance, I would see that the leasehold property was of 75,000 originally and has been depreciated by 15,000. So if I write down the net book value, I'm going to say 75,000 minus 15,000. This is the net book value opening. This is the net book value opening. So the property is at 60,000 initially. Then I'm going to depreciate for 6 months. So what will be the depreciation? The question has given us the original life of 25 years, which is the total life. So how do we calculate depreciation using the total life? We divide the cost 75,000 divided by total life 25 years. This will give us the depreciation of the entire year. So multiply by 6 divided by 12. Now this spreadsheet is actually my calculator, and the examiner knows exactly how am I calculating these values. So the depreciation is going to be 7,500 and the net book value is going to be 60,000 minus 1,500. So net book value is 58,500 before revaluation. When the question said that the fair value was 66,300, where is 66,300 written? Over here. The directors have decided to revalue the lease property at 66.3 million. So this is the fair value on this date. This is the fair value on this date. So what is the amount of revaluation gain? The amount of revaluation gain is 66,300 minus 58,500. 66,300 minus 58,500 is the amount of revaluation gain, which is 7,800. And then we have to depreciate again for the remaining 6 months. And for the remaining 6 months, can someone tell what will be the amount of depreciation? Smita, this is how I've calculated 60,000. The cost in the trial balance of 75 minus the depreciation in the trial balance of 15. This would become 60,000. So if actually we see, if I calculate the total life given by the question was 25. The total life given by the question was actually 25, and the annual depreciation was 75,000 divided by 25 years. So 3,000 is the annual depreciation. And if I calculate the accumulated depreciation, was 15,000 given in the trial balance and 1,500 charged by us. 15,000 given in the trial balance and 1,500 charged by us for the first 6 months. So the accumulated depreciation is 16,500. So if I calculate the age of the asset has been depreciated by 16,500 with an annual charge of 3,000. So the asset's age is actually 5.5 years. The asset's age is actually 5.5 years. So what is the remaining life of the asset? The remaining life is actually 25 minus 5.5. So the remaining life is 19.5. So the depreciation is going to be fair value divided by 19.5. This will again give us an annual depreciation. So multiply by 6 divided by 12 will give us the depreciation for 6 months, which is 1,700. So we have got one correct answer from Hamza Ahmed. This was the correct answer. Arslan Beg has made an error. He has not applied 6 by 12. Shizan Nazia wants me to repeat 5.5. Actually, Shizan Nazia, the total life was 25 years. And the annual depreciation is calculated as 75,000 cost divided by 25 years. So the annual depreciation was actually 3,000. The annual depreciation is 3,000. Now, if I calculate the accumulated depreciation, the depreciation in the trial balance was 15,000. Given in the trial balance was 15,000. Smita, your question is also the same. And plus we have depreciated for 1,500 more for the first 6 months. So up to the first 6 months, the accumulated depreciation has become 16,500. Is it clear, Smita? Now if the accumulated depreciation is 16,500, the age is going to be 16,500 divided by 3,000. Good. 16,500 divided by 3,000. This is the age of the asset, which is 5.5 years. So if the age is 5.5 years, then the remaining life is 25 minus 5.5. 25 minus 5.5, which is 19.5. And the depreciation would become 66,300 divided by 19.5 into 6 by 12. Nazia and Shiza, are you clear now? Okay, good. So the final net book value at the year end is going to be 66,300 minus 1,700. This is the final net book value that should go in the statement of financial position. So now what impacts do we need to record? We need to record the depreciation for the first 6 months, depreciation for the last 6 months, and we need to record the revaluation gain in OCI. So the impact is 1500 depreciation, 1700 depreciation in P&L, 7800 in OCI, and 64600 in the balance sheet. So if I move towards my accounting entries, I'm going to say cost of sales debit and the property credit by 1500 plus 1700. So this is the amount of the depreciation of the property. Yes, Ahmed Junaid, the revaluation gain will go to the OCI. Now we know that the plant will also be depreciated. So we can write plant along with this, and then we can calculate the cost of sales as the sum of property, plant, equipment, the sum of property and the plant. So this will automatically record the total depreciation altogether, both of the property and the plant. Nazia is saying we also charge tax and revaluation. Nazia, if the question would say we will charge, but if the question is silent, we won't charge. So we had studied the question till over here. Now I'm reading further. The question says that Triads company does not make an annual transfer from the revaluation surplus to retained earnings to reflect the realization of the revaluation gain. They do not transfer the revaluation gain. Good enough. However, the revaluation will give rise to a deferred tax liability at the company's tax rate of 20%. So we need to record the revaluation and the deferred tax both. So first I'm writing the revaluation, property debit, revaluation reserve through OCI credit, and then its deferred tax impact, revaluation reserve through OCI debit, and deferred tax liability credit. So this is the entry to record the revaluation and then the tax. Now what was the amount of revaluation? 7800. I've written equals to and then I've linked the value so that the examiner knows from where am I bringing this 7800. And the tax is going to be 7800 into the tax rate of 20%. So the tax is 1560 and the deferred tax liability will be the same 1560. So now we have charged the depreciation, we have recorded the revaluation, and we have recorded the deferred tax on the revaluation. All impacts have been done. Smita wants to know 1560 again. Smita, the tax rate given in the question was 20%, and the question has said that the revaluation will give rise to a deferred tax liability at the company's tax rate of 20%. So this will result in a deferred tax liability. So I have credited deferred tax liability. Okay, good. Smita has already got this even before completing, even before my answer. That's good, Smita. Any other question from anyone else? Now we are charging the lease property, the depreciation of the plant as well. The question says that the lease property is depreciated on the straight line basis. We have already depreciated it on the straight line basis. And plant and equipment at 15% per annum using the reducing balance method. So now I'm going to charge depreciation on plant using reducing balance. So I need to know the cost of the plant, which is 72,100, and the depreciation, which is 28,100. So I'm writing equals to a bracket 72,100 minus 28,100 will give me the net book value of the asset. And then I'm going to apply 15% depreciation rate on this. So this is the formula of calculating the depreciation for the plant. So the answer is 6,600. Yes, Mas. And if you see, the cost of sale value has been updated automatically. So now I don't have to remember that whether I've added it in the cost of sales or not. The working has been done automatically by the spreadsheet. Hamza Ahmad is asking why we have debited cost of sales to charge the depreciation. Hamza, if I go back onto the requirement, this is something that is normally written in the requirement, but in this case it is not written. So whenever the question is silent, we normally record the depreciation charges in the cost of sales. But if the question is silent, then you can even record it somewhere else. For example, if you can record it in the admin expenses, you can record it anywhere else, because this is not something which is important. The classification is not important, the calculation is important. Cooley is asking that the working is only for CB, right? Cooley, you have to show the working in the manual as well. You have to show the working in the manual as well. But right now I am showing the workings in the spreadsheet. You have to show all of the same in the on the paper and the pen. So in spreadsheet, normally it takes less time to perform the workings. If you are writing down along with my workings, it will probably take you more time to write down as compared of the speed that I'm typing. Although if I tell you I'm typing, I'm not typing at my speed. I'm typing it slowly so that you people can understand. So the higher the typing speed is, the less time will be consumed by the students. So now we have completed the adjustment number 2. Any questions for adjustment 2? Then we will be moving towards the adjustment number 3. Yes, Ahmed, 7,800 will go. No, not to the other income. It will go to other comprehensive income. The word OCI means other comprehensive income, which will be made after the P&L. But in this question, it is not required, so we will be taking it directly to the balance sheet. Mohammad Zuhaib is asking about age. Zuhaib, I have already discussed age in detail twice or thrice, so you need to refer the recorded lectures later now. Ahmed, Junaid is saying, but that ultimately goes to retained earnings, right? No, Ahmed, that will remain in revaluation reserve until the asset has been sold. Once the asset has been sold, only then it will be transferred to retained earnings. The revaluation gain will remain in revaluation reserve until the asset has been sold. Okay, Rabi Saeed wants to know how the plant has been calculated. Rabi Saeed, this is the working of the plant. That I've taken the cost from the trial balance of 72,100 minus I have charged the accumulated depreciation from the trial balance, and then I have applied the 15% rate given by the question. So 7,200 from the trial balance, 28,100 from the trial balance, and 15% from the adjustment. Okay, now let's move towards the adjustment number 3. Welcome, Rabi. In adjustment 3, the question says that in September 20x5, September is almost the near to the end of the year, the directors of Triage company discovered a fraud. They have discovered a fraud. In total, $700,000, which has been included included as receivables in the above trial balance, had been stolen by an employee. An employee has stolen the receivables of 700,000, and this has been included in the above trial balance. So what we need to do is that we need to credit the receivables. So I'm writing down adjustment number 3, receivables credit by 700. These have been stolen. $450,000 of this related to the year ended 31st March 20x5. Our year end is 31st March 20x6. So this means out of this amount, 450 were stolen in the previous year. The rest for the current year, and the rest have been stolen in the current year. So the amount stolen in the previous year will be adjusted with the retained earnings brought down. This will not affect the current P&L. So 450 to be adjusted with the retained earnings brought down, and the remaining amount which have been incurred during the year will be recorded as an expense. So all expense items can be recorded in cost of sales. So I'm writing 700 minus 450, and the answer is 250. So the receivables have been de-recognized by 700 because they have been stolen. We cannot recover them. And The amount lost in the previous year were 450, and then in the current year 250. Now the question further says that the directors are hopeful that 50% of the losses can be recovered from the company's insurers. Now the question is, should we record the 50% receivable from the insurers or not? What do you people think? That should the 50% of the amount that we were expecting to be recovered should be recorded as a receivable or not? He's saying no, Cooley is saying no. Yes, the answer is no. Because the question says that we are hopeful. It is not virtually certain because it is a contingent asset. So we are going to record the receivable only when the inflow is virtually certain. So we are going to ignore this statement of the question, and there is no impact of this in the question. Now let's discuss adjustment number 4. I'm moving a bit down. I'm writing down adjustment number 4. Now all the workings, adjustments, and the P&L and the balance sheet will be given to the examiner as we are performing. The examiner will even be able to see the formulas that we have used. Nabil, there is no working for adjustment number 3. The receivables that have been stolen are 700 given by the question. This 700. Out of which 450 related to the previous year, again given by the question. And the differential value we have recorded in cost of sales, which is the difference between 700 and 450. So there is no as such working for adjustment number 3. Okay, now in adjustment number 4, the question says that a provision of $2.7 million is required for current income tax on the profit for the year to 31st March 20x6. So this is the current tax current year. So we are going to write tax expense debit and provision for tax credit. This provision for tax will be taken as a current liability in the balance sheet. So the amount of the provision for tax is actually 2,700. So I've written 2,700 over here. This is a current liability in the balance sheet. Then the question further says that the balance on current tax in the trial balance is the under over provision of tax for the previous year, which means the question is talking about the prior year. This is current tax prior year, which has been written in the trial balance. So if I move towards the trial balance, I can see a debit balance of 700. So the question is saying that this is something that relates to prior year. So a debit means an under provision in the last year, and this would increase the tax expense during the year. So I'm writing current tax, which I've taken from the trial balance, which is of 700. So I'm crediting it, I'm removing it and taking it to the tax expense. So all these values will be added in the tax expense. So I can say the tax expense is the sum of all three: the current tax current year, the current tax prior year, and the deferred tax. Although I haven't written the value of the deferred tax yet, but I know I'm going to write. So the tax expense is the sum of all three: the provision for tax, which is current tax current year, current tax prior year, and the deferred tax. So up to now the expense is 3,400. Now if I move back again onto the question, the question further says, in addition to the temporary differences relating to information in note number 2, the question is talking about the deferred tax on revaluation. So in addition, apart from the revaluation, at 31st March 20x6, the carrying amount of Triad's company's net assets are 12 million more than their tax base. So the carrying amount is higher, which means that this would result in a deferred tax liability. If the carrying amount is higher and the tax base is lower, this means that this would result in a deferred tax liability. So how much amount of liability? 12,000 multiplied by 20%, which was the tax rate given above. This is the 20% tax rate. So the deferred tax liability carried down is actually 2,400. Smita wants me to repeat. Smita, whenever we are going to calculate the deferred tax, how we calculate? We calculate tax base minus carrying amount into the tax rate. a positive answer becomes a deferred tax asset and the negative answer becomes a deferred tax liability. So the question says that the carrying amount is higher than the tax base. So this means the tax base is lower. So the answer will be positive or negative. What do you think, Smita? The answer will be positive or negative? Negative, yes. So if this is negative, this means that it is a deferred tax liability. So this is how we are going to check whether it is an asset or a liability. Clear, Smita? So deferred tax liability carried down is 2400. Welcome. And deferred tax liability brought down will be given in the trial balance. So if I move back towards the trial balance, I can see that the deferred tax is given as 3200. And as it is given on the credit side, this means that this is a liability brought down. If it would have been on the debit side, this would become it as a asset brought down. So the liability brought down is actually 3200, and the carried down we have calculated is 2400. So if I calculate the movement, which will go to P&L, the liability is actually decreasing by 800. The liability, the deferred tax liability, is actually decreasing by 800. Yes, Hamza, you can use the word tax payable instead of provision. So a decrease in liability would mean that I should be debiting the deferred tax liability. So I'm cutting this. I've used the Control X key and then Control V. So the deferred tax liability should be debited by 800, and my formula has stopped working because I have changed the sequence. So I have to reapply the formula. 2700 plus 700 minus 800. So the total expense to be shown in the income statement is actually 2600. The total expense to be shown in the income statement is actually 2600. So this is how we have solved the adjustment number 4. Ahmed Junaid is asking what is 2700? Ahmed, 2700 is the provision for tax or the tax payable or the current tax current year. All the names are equal. Kuli wants me to repeat. Kuli, what we have done is actually the provision for tax of 2700 and the current tax of 700 will increase the tax expense. So I've added both of them, 2700 plus 700, and the deferred tax liability has been decreased. So liability debit, tax expense credit. So this will reduce the tax expense. That's why I have deducted this. Yes, Ahmed. So the current tax is 2700 plus 700. Kuli, are you clear now? He's saying my confusion comes as a result of deferred tax liability gotten from the revaluation reserve. Kuli, the deferred tax liability from the revaluation is something else, because the question has informed us that these are the values which are in addition to the temporary difference relating to the information given in the 2 above. So actually when we are taking the liability in the balance sheet, that will be something else. That will not be 2400, because that would include the liability on the revaluation as well. So what we have done is right now we have just prepared the entry. For as the 800 is from this is the balancing figure. Carried down minus brought down is showing whether to increase or to decrease. For as 800 is the difference between the brought down and the carried down. Smita is asking from where did 2400 come? Smita, the question had informed us that the temporary difference is $12 million. $12 million. The carrying amount was 12 million more than the tax base. And the tax rate is 20%. So 12,000 into 20% is the deferred tax liability carried down. This is how we have calculated the carried down. Ahmed is asking, so basically impact of deferred tax liability is already included. Yes, exactly, Ahmed. No, the revaluation impact has not been included. The revaluation impact will increase further. The revaluation will increase further the deferred tax liability. So if you want to know the carried down liability, the actual carried down liability which will be taken into the statement of financial position will be 2400 plus 1560. This is the liability which will be taken in the balance sheet. So the 2400 does not include the impact of the revaluation, because the question has said that this is in addition to the temporary difference in note 2. Note 2 was about revaluation. So this 2400 is other than the revaluation. This 2400 is other than the revaluation. Okay, now let's calculate the final requirement of the question, which was to calculate the adjusted profit or loss. Ahmed is saying, so shouldn't we compare 3960 with 3200? Ahmed, if you are comparing 3960 with 3200, that would have both the impacts of P&L and the revaluation. If you are comparing 3960 with 3200, that will have both the impacts of P&L and the revaluation reserve. So the impact of the P&L is 800 and the impact of the revaluation is 1560. So that will be more confusing for you. So keep both of them separately. The revaluation impact separate and the P&L impact separate. If you combine both of them, you will get more confused. So let's start the first requirement of the question, which was to calculate the adjusted profit. So I'm writing profit before interest and tax from the trial balance. This is the value from the trial balance. And I'm minimizing the screen so that I can get more of the spreadsheet. So the profit before interest and tax given in the question was actually profit before interest and tax was actually 30,000 given in the question. So starting from 30,000, now I'm going to write adjustments starting from adjustment number 1. In adjustment number 1, we have debited the finance cost. So this finance cost will actually reduce the profits. Finance cost debit will increase the finance cost and will reduce the profits. And I'm selecting all these and marking them as rounded off values. So adjustment number 1 has been incorporated. I have made it bold so that I remember what impacts have been included and what impacts have not been included. And any value that have been used from the trial balance will not be incorporated anywhere, because it is an account which has been created by the question and we have actually eliminated it. So any value used from the trial balance will not be incorporated. So apart from this, if I refer to adjustment number 2, we have debited the cost of sales by 9,800, so equals to minus 9,800. So now the examiner would know from where am I getting the values, and I've made it bold so that I remember that I've incorporated this as well. Similarly, there will be some impact from adjustment number 3, and there will be some impact from adjustment number 4. So if I refer to adjustment number 3, we have debited the cost of sales by 250. So debit cost of sales will actually decrease my profits, increase cost of sales and reduce the profits. Smita, I have done nothing with the 2400. I have done nothing up to now with the 2400 balance. Okay, now adjustment number 4, we have written the tax expense. So the amount of tax expense moving down, the amount of tax expense is 2600. So I'm making this bold as well. So I've incorporated this, and the current tax has been taken from the trial balance. So this is also in bold. Ahmed is saying we first add 2400, then subtract 3023, right? Because 2400 was taken as the interest expense, which was wrong, and it should be written exactly, Ahmed. You're right. So we have removed 2400 and we have added 3023. Okay, now, so this is the adjusted profit that was required by the question. So 14347 is the corrected profit for the year. So this was the first requirement, which was part A, which we have completed. Any questions relating to part A? And then part B, the question required the statement of financial position. So in the statement of financial position, we start from non-current assets and we write property, plant, and equipment. So if I write the value of the property, plant, equipment, I'm going to adjust these four values basically. These two are the cost of the property and the plant, and these two are the depreciations. So I'm writing equals to 75,000 plus 72,100 minus 15,000 minus 28,100. So these are the impacts from the trial balance. Now I'm going to adjust the entries minus 3,200 minus 6,600 and plus 7,800. These are the impacts relating to the property and the plant. We have depreciated both property, plant, and we have revalued the property. So the final answer is going to be 102,000. I'm marking these as bold. Marking this as bold. We have already incorporated now. And then I'm copying the non-current asset, pasting over here, and just changing the wording. So now I'm writing current assets. And if I see the current assets, the question has given us two of the values, the trade receivables and other current assets, which are going to be 28,000 and 9,300. So I'm writing trade receivables and other current assets. So trade receivables is 28,000, but if you remember, we had some stolen receivables of 700. So we are going to subtract this, and I'm marking this as bold to remember that I've incorporated this. And the other current assets is 93. There is no adjustment in this. So the sum of all these will become the total assets. Again, I'm rounding off these values so that I can get a comma with everything. So now I'm writing the equity, starting with the equity shares given in the question, which is 50,000. And apart from this, we have retained earnings given in the question. And we have calculated a revaluation reserve. And plus we have calculated an other equity. So these are all the areas. Equity given in the trial balance is 50,000 and retained earnings is 3,500. So I'm writing equity as 50,000. Retained earnings are 3,500 plus the corrected profit that we have calculated in A. So the corrected retained earnings is 17,827. The revaluation reserve is going to be 7,800. Sorry, 7,800 minus 1,560. So I'm marking these as bold, incorporated. And there's one more adjustment relating to retained earnings, which was 450 debit. So debit means to reduce the retained earnings. So now we have everything written. So we will not be forgetting anything in that balance sheet. So all the bold impacts taken, 6% loan note still to be taken impact. Ahmed is saying, so we have added 2400 in 30,000 before subtracting 3023. Yes, Ahmed, I didn't get your question exactly. If you're talking about loan notes, we are going to move towards there. Okay, now I'm writing the equity option, which was on the top. So I'm going to bold this. I have already incorporated. So the equity option, I've got it. Now the total equity is going to be the sum of all these. So this is the amount of total equity. Anywhere where I have calculated the total, I'm going to bold that so that I remember that this is the total of the previous values. Now I'm going to write current, non-current liabilities, where I have 6% convertible loan notes and I have deferred tax liability. So the loan notes in the question were actually 30,000. No, 40,000. The loan notes in the question were actually 40,000 and the deferred tax liability was 3,200. This 3,200. Yes. So I'm writing equals to 40,000. But if we see in adjustment number 1, we have actually debited the loan notes and then we have credited the loan notes by 623. So the right value will be after incorporating these. I'm marking these as bold, Control B, and I'm marking this as bold. So now the adjustment 1 has been completely incorporated, 2 has been completely incorporated other than deferred tax, and 3 has been incorporated completely, 4 deferred tax and the provision for tax left. So the deferred tax is 3,200 plus 1,560 minus 800. So this is the amount of the deferred tax. So marking this as bold, incorporated, marking this as bold, incorporated. So now the only thing left is provision for tax, which will be a part of current liabilities. So I'm copying the non-current liability and just changing the non-current to current. And if I go to the trial balance, I will see the current liabilities are already given in total. So the value of the current liability is 17,700. So I'm writing 17,700 plus 2,700, which is the provision for tax. So now I'm going to get total equity and liabilities, which is going to be the sum of these values. And we have got 138,600 on the credit and the debit both. So we have actually balanced our first question relating to the final accounts. So the formatting is not necessary, but I'm still applying the formatting on this. So this is how we have actually calculated all of the adjustments. If you see, all of my double entries will now be in bold, because I have incorporated all of them. If my balance sheet is not balanced, this means that I've forgotten to incorporate any of the impacts. Faraz is saying that can we get the Excel sheet saved somewhere? Actually, Faraz, right now I'm using one of my own platforms at hamzaabdullah.com. If you want access, you can message me on the WhatsApp group. I will create an account for you and give you the access. You can simply save the Excel easily over there. So if you click on the submit button, it will get saved. So if you want the access, you can post me. I will give you the access. So any confusion with the first question? Okay, everyone, no leaves, not a break. So we are going to resume now towards the next question, and then we will be taking the break in 15 to 20 minutes time, and then we will continue again. So let's solve the new question. It's by the name of extol, and let's start reading. Okay, now we are starting the next question. The question says that the following trial balance relates to extol as at 31st March 2014. So this is the year end. So again, I'm keeping 4 columns, although I won't be using 4, but I'm keeping them just to be on the safe side. I'm going to write adjustments over here, and then 4 columns for the adjustments. And then I'm going to show my workings over here. So let's check what is the requirement of the question. The question's requirement is to prepare the statement of profit or loss for extol for the year ended 31st March 2014. So we are going to prepare the P&L and prepare the statement of change in equity for extol for the year ended 31st March 2014. And then we have to prepare the statement of financial position. So there are total 3 requirements. The first requirement is to prepare the profit or loss. Second is to prepare the statement of change in equity. and third is to prepare the financial position, and then we have to calculate the basic earnings per share for Xtol. So this is the entire requirement. First part is of 8 marks, second 6 marks, third 8 marks, and then fourth 3 marks. This is a total 25 marks question. Oh yes, Lee, we forget to solve the EPS in the last question. So let's solve this. Let's solve the EPS in this one. So it is more or less the same. So you people can try the EPS at your own. So now let's go through the trial balance. The question has given us the revenue, the cost of sales, distribution cost, administrative expenses. The loan note and the dividends paid have been given together, so we need to break these. So there's a bank interest which will be recorded in the finance cost, 20-year lease property. So 20 years means the total life, so we can depreciate the lease property directly. The plant at cost, the depreciation of lease property, plant, inventory, receivables, payables, the bank is overdraft. Equity shares of 25 cents each, share premium, retained earnings opening, 5% convertible loan notes, current tax is debit, which means under provision. So this will actually increase the tax expense, and the deferred tax brought down of 4,600. So let's start solving. The following notes are relevant. Now the question says that revenue includes an amount of $20 million for cash sales made through Xtol's retail outlets during the year on behalf of another company, which is Francis. Xtol acting as agent, Xtol is the agent, is entitled to a commission of 10% of the selling price of these goods. So actually, Xtol is the agent and will receive a commission of 10%. But Xtol has recorded the revenue of $20 million, which means the revenue has been overstated. Overstated by what amount? What do you people say? Overstated by what amount? The revenue has been overstated by, yes, Hamza, 18. No, wait, not 2018, because we can record the revenue of 10%, which is 2. So we are actually debiting the revenue. We are actually debiting the revenue by 18,000. We can even remove the entire 20 and record 2,000 in the other income, but even we can still record the revenue of 2 as well. So the 2,000 can either be recorded in the other income or the revenue. Both treatments are correct. 2,000 can either be recorded in revenue or the other income. Both treatments are correct. So we are debiting the revenue by 20. Yes, Yumna, you are right. Now the question further says that by 31st March 2014, Xtol had remitted to Francis $15 million. So we had received 20 million. Now we have paid 15 million. What is left? 5 million. Out of which 2 relates to us. Remaining 3 is a liability. We have received 20. 2 relates to us. 18 we have given to Francis. We have paid 15. So the remaining amount is now 3,000. So we can say that the payable should be recorded by 3,000. And the question further says that Xtol had remitted to Francis $15 million of the 20 million sales and has recorded this amount in the cost of sales. So which means the cost of sales are also overstated by 15 million, which is 15,000, as we are writing all of the entries in the thousands. So this is how we have prepared the entry, the revenue being debit by 18,000, cost of sales being credit by 15,000, and payable being recorded by 3,000. Smita wants me to discuss 3,000 again. Actually, Smita, the cash that we have received is actually 20,000, and the amount that we have already paid is 15,000. And the commission, the amount that is our commission, is actually 2,000. So the remaining amount is going to be 3,000. This is the amount of payable that should be recorded. So we have received 20. We have given 15 to Francis. 2,000 is ours. We are going to keep it with us. Remaining 3,000 is the payable that we need to pay to Francis, to the to the principal of this transaction. Clear, Smita? Hamzal is saying the amount paid of 15,000 will not be recorded by crediting bank. Actually, Hamza, if I write down the correct in the incorrect entries, the correct entry was bank debit by 20,000, bank credit by 15,000. The bank that we have received, okay, the bank that we have received debit by 20,000, the amount that we have paid credit by 2,000, revenue credit by 2,000, and payable credit by 3,000. This is the correct entry that should have been recorded. This is the correct entry that should have been recorded, but the incorrect entry recorded by the question is actually bank debit, revenue credit by 20,000, and then the other entry recorded by the question is cost of sales debit, bank credit by what amount? By 15,000. So now these are the entries which have been recorded, and these are the entries that should have been recorded. So the bank has been correctly recorded by the question. Bank debit 20, bank debit 20, bank credit 15, bank credit 15. So we are not required to do anything with the bank. What is the problem? The question has recorded revenue of 20, although we should have recorded by 2. So we have reduced the revenue by 18, corrected this. We have corrected this revenue, and then the cost of sales have been recorded. So we have actually reversed this, corrected this, and then we have recorded the payable of 3. So this is how the incorrect and the correct entry has been converted into the correcting entry that we have recorded in the question. So this was the adjustment number 1. Now we will be moving to adjustment number 2. Okay, now in the adjustment number 2, the question says that the plant and equipment is depreciated at 12.5% per annum on the reducing balance basis, and all depreciation amortization of non-current assets is charged to cost of sales. So we need to charge the depreciation. So the cost of sales debit, property credit, and the plant credit. So the plant is depreciated at 12.5% reducing balance. So if we see at the cost, it is 155,500 and the depreciation is 43,500. So this is going to be 155,500 minus 43,500 into 12.5%. So you can refer this formula. The cost minus the depreciation into the rate will give us the depreciation of plant. And if you look at the property, the cost was 100 and the life is 20 years. So we can simply say 100,000 divided by 20 years is the depreciation on the property. So the total depreciation is the sum of both of these, which is 19,000. So this is what was to be done in the adjustment number 2, a pretty straightforward adjustment. There was nothing technical in this. Now adjustment number 3 is something new to you people. Adjustment number 4 relates to convertible loan notes that we have already discussed. Adjustment 5 relates to dividend. Adjustment 6 relates to tax. So majority of the adjustments we have already done. Let's discuss 3. And then after adjustment number 3, we'll be taking a short break and then we'll be continuing after the break. So in adjustment number 3, the question says that on 1st August 2013, Extol made a fully subscribed right issue of equity share capital based on 2 new shares at 60 cents each. So Extol has made a right issue of 2 new shares at 60 cents each for every 5 shares held. So I can say the brought down, the new issue, and the carried down. So whoever have 5 shares in the brought down, we have issued 2 new to them, and which means now they are going to have 7. Everyone who had 5 shares in the brought down, we have issued 2 new shares to them, and now in the year end, they are going to have 7 of them. So if I read further, the market price of Extol's shares before the issue was 1.02. This is being informed to calculate the EPS. The issue has been fully recorded in the trial balance. The issue has been recorded in the trial balance, which means that if I go to the shares of 56,000, is this the brought down value or the carried down value? What do people think? Is this a brought down value or the carried down value? Is this a brought down value or a carried down value? Carried down, carried down, carried down, carried down. Yes, this is the carried down value. So I'm going to write 56,000 divided by 0.25. What is 0.25? The par value. So I'm going to get the number of shares, which are 224,000. These are the number of shares that we will be using. Now, can you tell how many new shares were issued in this? Can you tell how many new shares were being issued in this case? Can you tell me how many new shares were being issued in this case? Hamza Ahmad is saying 89,600. Arslan Beg is saying 44,800. Okay, if we see the 224,000 is actually denoting 7 shares on an average. And if I multiply this by 2, I'm going to get the new shares, which is 64,000. So the number of shares are 64,000, which is correct by Muhammad Hunain and Hamza Ali. So the new shares that have been issued are 64. 224 divided by 7 into 2. Because this 224 is representing 7 and I want to calculate the 2. So 224 divided by 7 into 2 is 64. Similarly, if I say 224 divided by 7 into 5, I'm going to get the brought down shares, which are 160,000. So 160 is the brought down, 64 is the new issue, and 224 is the carried down. So if I write the entry for the issuance, it will be bank debit, equity shares credit, and the share premium credit. So the bank is going to be new issue of 64,000 into, for how much value have we issued? For the 60 cents. So into 0.60 is going to be the amount of cash, and the share capital will be recorded at its present value of 0.25, and the balancing figure is going to be the share premium. But you have to remember one thing, that this is an entry which has been already recorded in the question. This is an entity which has been already recorded in the question. Then why are we recording this? If it is already recorded, then why are we making a double entry? Actually, we are making the double entry just to incorporate this in the statement of changes in equity. This will be used while preparing the SOSHI, changes in equity. Smith is asking, how did we get the brought down? Smitha, there are 2 methods to calculate the brought down. Simply closing minus the opening. This is the brought down. Closing minus the new issue is the brought down. Closing minus the new issue. Or 224 divided by 7 into 5. It is the same. So you can calculate 160 in two ways: carried down minus the new issue, or carried down divided by 7 into 5. So we are done with the adjustment number 3. If there's any confusion, you people can ask. Cooley, I've just explained how did we get 160,000. Closing minus the new issue, or closing divided by 7 into 5. Both the methods can be used to calculate the brought down value. 16,000 is actually the new issue of 64,000 multiplied by the par value of 0.25. The new issue of 64,000 into the par value was 0.25. So we have used the par value to record the shares. Okay, do you people feel that there's a need of the break, or should we continue the question and take the break after completing it? What do you people say? Should we take a break and then continue again, or we should continue without taking the break? Because I think the solving of the question is not too much technical. Mohammed Unayan is saying break, Hamza is saying to continue, Nazir is saying to continue, Cooley is saying to continue. Lee is saying I need tea, Smita is saying to continue, and then Lee is saying lol. Okay. Let's ask from the admin to decide what to do. Okay, so after discussing with the admin, we have decided to continue the question, and then we will be taking the break after the completion of this question. And then after 10 minutes break, we will start the third question and then complete it up to maybe 115, 120, or 130. I hope that will not be a problem for you people, because practice is something which is more important than learning the standard. Learning is something else, and practicing, doing in the exam environment is something different. So we are continuing. Lee, if you want tea, you can take a short break of 5 minutes, and then you can come back. So you can have the tea along with the session as well. So that's your call, either to wait for the tea or to have the tea along with the session. So I will be trying to complete this question within half an hour. So, okay, that's good, Lee, you are staying. Apologies if your tea has been missed because of me. So adjustment number 4, the question says that on 1st April 2013, which is the date of the start of the year, if I refer to the question, the year end is 31st March 2014. So this means the question is talking about the start of the year. So on the first day of the year, Extol issued a 5% $50 million convertible loan note at par. Interest is payable annually in arrears on 31st March each year. The loan note is redeemable at par or convertible into equity shares at the option of the loan note holders on 31st March 2016. Okay, Smita, I will explain in a while. The interest on an equivalent loan note without the conversion right would be 8% per annum. So this is the market rate that we are going to use. The discount factor will be 8% and the cash will be calculated using 5%. So if I perform the working over here, I'm going to say year, cash flow, discount factor, and the present value. So year 1, 2, and 3. Why 3 years? Because this is going to be redeemed in 2016. So 2014, 2015, 2016 makes it 3 years. So the cash flow is going to be 50 million, which is 50,000 into 5% for year 1 Same for year 2. And in year 3, this will be 2,500 plus the repayment of the loan of 50,000. So this will become 52,500. So 2,500 is 50,000 into 5%, year 1, 2, 3, and in year 3, further 50,000 of the repayment. So the discount factors have been given again, 0.93, 0.86, and 0.79. So to calculate the present value, this is going to be 2,500 into 0.93. I'm copying the formula, pasting in year 2, pasting in year 3, and then I'm going to calculate the sum of all these 3 values to get the amount of the financial liability. And the remaining amount is going to be equity. So 50,000 minus 45,950 is going to be the equity. So this is how we have divided the components between liability and equity. Any confusion in this? This is the second time we are solving this type of question. And then we are going to prepare a table which will start from year, brought down, interest expense, and then interest paid, and then we have amortization, and then we have the carried down. So in year 1, the brought down of the liability is 45,950. Interest will be calculated using the 8% rate. Interest payment will be 2,500. So the amortization is going to be the difference of 1,176. And the carried down is going to be 47,126 in the balance sheet. So this is how we have calculated the table. And now I'm going to prepare the entry. If I look at the trial balance have recorded the 5% loan notes, the liability at the entire amount of 50,000. So I'm going to debit this 5% loan notes by 4050 because this is equity component. And I'm going to credit the equity option by the same amount of 4050. So this is the adjustment number 4 that we are solving. And then for the interest, we are going to debit the finance cost, the interest that we have paid, which is also there in the trial balance. Where in the trial balance is it? This is over here, along with the loan note interest and the dividends paid. This 13,380 actually includes both the dividend and the interest. So if I write it down on the scratch pad, the total given by the question is 13,380, out of which the interest is 2,500. So the amount of dividend is going to be the difference, which is going to be what amount? 13,800 minus 2,500 is going to be 11,300. So I've written it down so that I can remember later. Thank you, Neeraj. Okay, Smita is saying 10880. Let me check again. 13,380 minus 2,500 is 10880. Yes, Smita is right. So it's 10880. 10880. So this is the amount of dividend. Actually, I've written an incorrect value over here. It's 13380. Okay, so 10880 is the amount of dividend. And now I'm going to write the 5% loan notes over here. I can simply copy and paste. So finance cost is 3676. Interest paid is 2500. And the amortization is the difference between both of these. So this is how we have completed adjustment number 4. If you people have any confusion, you can ask. Then we'll be moving towards adjustment 5. So in adjustment 5, the question says that an equity dividend of 4 cents per share was paid on 30th May 2013. And after the right issue, a further dividend of 2 cents per share was paid on 30th November 2013. So we have paid 4 cents before the right issue and 2 cents after the right issue. So if I go where we have calculated the opening and the closing shares, and I write the amount of dividend, so the dividend is 4 cents before the right issue and 2 cents after the right issue. So the 4 cents dividend has been given on the 160,000 shares. Okay, Smitha wants to take the snapshot. Just a while, Smitha. So 224,000 into 0.02 will give us 4480. So if I calculate the total dividend, this is going to be 6400 plus 4480, and we have got the same dividend 10880 that we have also calculated from the trial balance. So this means that we are going on the right direction. If our value would have been different, this would have meant that we have made some error. So in adjustment number 5, there was nothing to calculate other than the amount of dividend that we have already calculated. So if adjustment 5 was not there, we could have still calculated the amount of the dividend that have been paid. Any confusion so far? Okay, so now let's discuss adjustment number 6. In adjustment number 6, this basically relates to the deferred tax, which is quite easy. In adjustment 6, the question says that the balance on the current tax represents the under-river provision of the tax liability for the year ended 31st March 2013. So if I go on to the trial balance, the question is talking about this current tax, which is a debit balance. So the entry is going to be tax expense debit, and the current tax that we have taken from the trial balance as being credit by 3200. Similarly, apart from this, there are total 3 impacts which are recorded in the tax expense. The current tax current year, the current tax prior year, and the deferred tax. So the question further says a provision of 28 million is required for the current tax for the year ended 31st March 2014. So this is the amount of provision for tax, or we can say tax payable, which is actually 28,000. Okay, Angela was not able to hear me on adjustment number 5 clearly. Is everyone else able to hear me properly? Okay, please wait for a while. Okay, so let's continue. So we have written the value of 28,000 as provision for tax. Now the question says that further, and at this date, the deferred tax liability was assessed at 8.3 million. So the question has already given us the deferred tax liability. So I'm writing TTL brought down, DTL carried down, and the movement to be recorded in P&L. So the carried down is 8,300 given by the question. Let's move towards the brought down, which is 4,600. So the movement is actually an increase in the liability of the difference between the both, which is 3,700. So the deferred tax liability will be credited by 3,700, and the balancing figure in the P&L tax expense would become 34,900, which is the sum of all three: the current tax, the deferred tax, and the prior year. So all adjustments have now been done up to adjustment 6. Now we have to prepare the income statement and the financial position. So I'm moving on the top. I'm writing statement of comprehensive income, which we're going to start from revenue, and then cost of sales, and then gross profit. And we have no other income or the investment income, so I would write administrative expenses, distribution cost, and then we have finance cost, we have profit before tax, and then we have the tax expense, and then profit after tax. So this is the simple format of the comprehensive income. So if I write down the revenue from the question, it was actually $490,000 minus we have debited revenue by 18,000. So the corrected revenue is 472. I'm making this bold. And then the cost of sales written by the question is 290,600. I'm moving this a bit so that my Excel sheet enlarges. Adjusting this to get to know what impact is where. So the cost of sales is actually 290,600 minus 15,000. We are reducing the cost of sales plus 19,000. So the amount of cost of sales is 294,600. So 472 minus 294,600 will give us the gross profit of 177,400. Now the administrative expenses are 36,800. If you want to write these values as a negative, you can even do that, but use a bracket in that case. So this would become negative, and now the gross profit will be the sum of these two. And in preparing the income statement, what we can do is we can use a different format which can be selected from over here. So this will actually convert the negative values into brackets so that it looks like more of an income statement. But these are all part of the formatting, which is not necessary in the exam. So the administrative expenses is negative 3,600, distribution cost is negative 3,500. I'm making this cost of sales bold. This cost of sales is bold. I've incorporated these. And now if I look at the finance cost, is there any finance cost given in the question? The bank interest 900. So I'm going to write equals to 900 plus the finance cost on the loan notes. So making this bold and then writing a negative with a bracket. Do remember to write down brackets, otherwise your values will be incorrect. So now the profit before tax is the sum of all these. I'm making this bold to make it know that this is a total. And then the tax expense, we have calculated it in the last adjustment, 34,900. So I'm making this bold too. Interest paid has been taken from the trial balance. Current tax has been taken from the trial balance. So these will have no impacts. So the profit after tax is going to be the sum of all these. So it is 67,624 is the profit after tax in this case. So requirement A done. Now the requirement B was to prepare the statement of change in equity, and requirement C is the financial position. So I'm starting from the financial position first. Statement of financial position. Non-current assets. This will include the property, plant, and equipment. So the property, plant, equipment was 100,000 plus 155,500 minus 25,000 minus 43,500. This is from the trial balance, and then minus 5,000 and minus 14,000. So this will give us the value of the property, plant, equipment. These impacts have been incorporated now. And again, I'm selecting these and making this to rounded off values. So after property, plant, equipment, we have current assets. Okay, again, formatting is not important, but I'm doing it right now so that it is easier for you people to understand. Now we have inventory, receivables, and the bank is overdraft. So the inventory is actually 61,000, no entries in the inventory. Receivables are 63,000, no entries in the receivables. So the sum of the debit side is going to be 292,000, which is going to be the total assets. And on the credit side, we have equity. Equity would include the equity shares, which were of 56,000. And then we have share premium. And then we have retained earnings. And we have the equity option. This will give us the total equity amount. But obviously we are going to calculate these values from the statement of change in equity. I'm making this bold. And then we have non-current liabilities, which will include the 5% loan notes and the deferred tax liability. And then we have current liabilities where we have trade payables, we have bank overdraft, we have tax payable, which is also known as provision for tax. So these are the impacts. So right now, starting from the loan notes were 50,000 minus, we have debited the loan notes by 4050 and added 1176. So this will give us the value of the loan notes, 4050 and 1176. So I'm making these values also rounded off. Now if we see at the deferred tax liability, this was given as 4600 and we have credited this liability by 3700, so we'll get the same carried down of 8300. But I usually don't use this 8300 because this may even change because of any revaluation impact on deferred tax. So try to take the trial balance value and then incorporating the entries. Now the trade payables are given in the question as 32,200. The bank is given as 5,500. And we have recorded the provision for tax as 28,000. So provision for tax incorporated, deferred tax incorporated. Now let's see if we have left anything. Equity option has been left. That is part of SOSHI. And payables has been left. We had actually forgotten this. So whenever we are forgetting anything, we will get to know from the double entries. So I have to increase the payables. So in the payables section, I'm going to write equals to 32,200 plus, and then I'm going to refer so that the examiner knows from where this value is coming. So now the payables are done. So if we write the total equity and liabilities, this is going to be the sum of all these, but right now we haven't written the total equity, so the value won't match. Now we are starting the statement of changes in equity. So we have equity shares, we have the share premium, we have the retained earning, we have the other equity, and then we will be getting the total. So we write the brought down, we write the total comprehensive income, we deduct the dividend, and if there is any new issue, we write that. And all these will make the carried down value. So if I start from the trial balance and I see the equity shares is 56,000, the premium is 25,000. But are these values the opening values or the closing values? These are actually the closing values. So 56 and 25 are going to be the closing values. Yes, Lee, these are closing. And the new issue we have already written in one of the entries, which was share capital is 16,000 and then the share premium was 22,400. So the brought down would become 56 minus 16, and this brought down would become 25 minus 22,400. And then I'm rounding off all of these values. Okay. So now the total comprehensive income or the dividend won't affect the equity shares or the share premium. Now let's down the retained earnings. The value of the retained earnings was 26080. So 26080 is the value, and other equity was 0. So the total is going to be the sum of all these. And I can copy paste them. Similarly, the total sum of this value is going to be the sum of all these. So now when I'm going to write the values, it will automatically calculate the closing balances. So the total comprehensive income will be seen from the P&L. So the profit after tax was 67624, and the dividend that we have calculated was 10880. That we have also written in the scratch pad. The dividend was 10880, and the new issue won't affect retained earnings, or the OCE will be affected. And this is the equity option that we had prepared. This is not bold, we haven't incorporated this, but now we have incorporated, so I'm converting this value as a bold. So all values are now incorporated. The balance should balance now. So the total equity is now 167874. So I'm moving upwards towards the equity section, and the equity shares are 56,000. And if I copy this and paste it beside this, so this will give me the share premium. We'll come over here, copy this, paste. This is going to give me the retained earnings over here. Copy this, paste this. This will give me the value of the OCE, which is not right. So I'm going to write manually the value of other equity, which is 4050. So the sum of all these is going to be 167874. And if we see, we have got the total as 292, which is the same, which should be the same as the asset side. And yes, it is the same. So we have balanced the second balance sheet of today. And this time we have comparatively have taken less time, because obviously this was the second question. So the third question will even take less time. Smith is saying, sir, you do statement of financial position before the SOSHI, even if it is asked to prepare SOSHI before SOF in the requirement. Smith, there is no, it is not necessary to follow the list of the requirements that first do this, then this, then this. There's no sequence. You can even start with Part D directly. So, so there's no specific requirement of following the list that has been given in the question. So normally, if there's no SOSHI, we solve the P&L and the balance sheet. So there's a fixed format: solve P&L, solve balance sheet, and then prepare SOSHI. Okay, now there was one more requirement in this question, which was to calculate the EPS. So when we are calculating EPS, we need profit after tax, which we already have in the income statement. It is 67624. This is the profit after tax. And then we need the weighted average number of shares. And how do we calculate the weighted average number of shares? I'm solving the working over here. The opening shares and then the right issue and then the closing shares. So we already have the movement, the working, so we can even directly refer to that instead of preparing a new one. So this is the area. This was the opening shares, the right issue, and the closing. So if I write that the opening value was 160, so now I have to apply this, multiply this by the number of months, and I have to apply the adjustment factor onto this. So I'm writing the date along with the brought down. The brought down was on 1st April 2014. And the new issue or the right issue was being done on which date? Let's see, on 1st August 2013, and the closing is on 31st March 2014. So opening, right issue, and the closing. So the number of months are from April, May, June, July, August, 5 months. So the brought down remains there for 5 months, and the right issue then remains till August, after August, September, October, November, December, January, February, March, for 7 months. So I'm going to apply 7 months on the value, the right issue, but I'm writing it in more detail so that you people are able to understand easily. So the opening was 160, the right issue is 64, so the total of these is 224, and I'm cutting the number of months, pasting it over here. So now I have to apply the adjustment factor as well. Adjustment factor is applied before the right issue. Yes, Neeraj, we are calculating the EPS. So if I calculate the weighted average number of shares, it is actually the number of shares into the months divided by 12 and into the adjustment factor, if there is any. And same applied over here. But in this, there is no need of applying the adjustment factor. So it is 224 into 7 divided by 12. And a big value, so I'm rounding it off to the rounded off value, and even this I'm going to round off. So now we need to calculate the adjustment factor. And how do we calculate the adjustment factor? How do we calculate the adjustment factor is that people who were having 5 shares are now given 2, so total they have 7. And the market value was originally 1.02, and the new share has been given at 60 cents. So 5 into 1.02, 2 into 1.06, and the sum of these is going to be 6.3. So the theoretical ex-right price is actually 6.3 divided by 7. So this is the new share price, 0.9. So the adjustment factor will become the market value divided by the theoretical ex-right price. This is how we calculate the adjustment factor. So I'm writing it to 2 decimal place. So the weighted average number of shares is the sum of both these. So the weighted average number of shares has become 206,222. Opening shares of 160 into 5 divided by 12 into the adjustment factor. And the adjustment factor is the market value divided by the theoretical ex-right price, and the theoretical ex-right price is 6.3 divided by 7. Mohammed Ahab, do you find any error in the adjustment factor? You are asking me to correct it, the theoretical ex-right price. Nazia, the adjustment factor is actually the market value before the right issue and the value after the right issue. The value before the right issue and the value after the right issue. No, Cooley, there is no simple way of calculating the weighted average number of shares. This is one of the complicated workings. So market value before the right issue was 1.02 and after the right issue is 0.9. So this way we have calculated the adjustment factor. And I'm writing down that this is W14. The weighted average number of shares is W14. So if I go down, I can write equals to W14 so that the system can directly take the value from over there. And now the basic EPS is going to be profit after tax divided by the number of shares, and I'm writing down this to 2 decimal places. So $0.33 is the basic EPS, or we may say 33 cents. It is the same. So 0.33 or 30 cents means the same. Okay. Are you all clear with the adjustment factor, or you need me to discuss it again? Hamzali, what is 120? You have written 120. I cannot understand your point. Smith is saying I didn't understand the 1.13 adjustment factor. Actually, Smitha, the treatment of adjustment factor is a bit difficult, but this is something that you would learn in detail in your paper F9. Right now, we have just solved this at a basic level. Adjustment factor is actually, if I write over here, adjustment factor is equals to market value divided by theoretical extra price. This is the formula of adjustment factor. And what is theoretical extra price? This is the value of the total investment. Previously, shareholders had 5 shares of 1.2. Now they have got 2 more shares of 0.6. So their total investment is 6.3 in 7 shares. So each share is of 0.9. So the adjustment factor is actually market value of 1.02 divided by 0.9, which will give us 1.13. And this is being used to calculate the weighted average number of shares. So now you don't need to properly format these workings. These workings are easily understandable by the examiner of what value is coming from where. And with this, we have completed the second question of today's session. I hope you people are understanding all of the questions properly, and the CB format is also not too much difficult for you people. You just have to type and perform the formulas equals to sum, this plus this minus this divided by this multiplied by this. Okay, Lee is saying, how do you suggest we incorporate all these working in the paper-based exams? Okay, Lee, for you, what I can do is I can solve the third question on the pattern of the paper-based exam. So it will be more easier for you people to understand how all of these tasks are done in the paper-based exams. So it is not too much different. Only the working that we are doing on the spreadsheet will be done on the paper and the pen. Yes, Sheikh Saqib, the scrolling right, left, up and down, and so much of values on one sheet comparatively makes it a bit challenging, but this is something we are not used to. That's why it is creating the problem. Otherwise, that would not create too much of the problem. So let's take a break of 10 minutes. It's 12:16 with me. So we are actually taking a break, and it's 12, almost 17 now. So 10 minutes break will become 12:27. We are going to resume at 12:27 and see you in 10 minutes time. Lee, do have some tea and then join again. Okay, everyone, let's continue with the third question for today's session. And the third question is by the name of Dawning Company. So the question has given us a trial balance with equity shares, other equity, retained earnings opening, 5% convertible loan notes, land and building at cost with land element of $14 million, plant and equipment at cost, patent at cost having a 10 years life, and then the depreciation or amortization of all of these. And then we have inventory, receivables, bank is on the credit side. So this is again overdraft, current tax, deferred tax, revenue, cost of sales, distribution cost, administrative expenses, and then we have a contract asset, which is IFRS 15. We have loan note interest paid, bank interest, other operating income from royalties, trade payables, and then we have the adjustments. So let's start reading the adjustments first. So I'm writing the answer on the next sheet so that you people are able to see this properly. So this is the answer sheet and this is the question sheet. Okay, now the question says that revenue includes an amount of $16 million for a sale made on 1st April 2015. This is the start of the year. The sale relates to a single product and includes ongoing servicing, which means that we have sold goods, plus we are giving the services as well. Thank you, Neeraj, technology. So includes ongoing services from Downing Company for 4 years. So we are going to provide the services for 4 years. The normal selling price of the product and the servicing would be 18 million and 500,000 per annum. That makes 2 million in total respectively. So this is a case of IFRS 15. So if we see the product has a value of 18 million, which means 18,000, and the servicing has a value of 2 million, so the total is 20,000. And instead of 20,000, we have given them these products and services at 16,000. So now what is the breakup of 16,000? Can you people calculate? We have studied this yesterday in IFRS 15. We have studied this yesterday. Can you please calculate the breakup? The breakup will depend on the standalone prices. So out of the total of 20,000, 18,000 is actually 90%, representing 90%, and servicing is representing 10%. So Arslan Beg is saying 16,200, 14,400. Screen to question. Neeraj wants to see the question. Here you go, Neeraj. Product is 14,400 according to Hamza Ahmed and Simeon and Lee. So a lot of correct answers. So 10% of 16,000 is actually 1,600, and for the product it is 14,400. So yes, a lot of correct answers are there. So now this 16,000 actually relates to the product, 14,400 to the product, and remaining 1,600 to the servicing. But this servicing actually relates to 4 years, out of which 1 year has passed by, but 3 years have not. So 1,600 is for 4 years, so the annual revenue is actually 400. So 1 year that has been passed relates to the revenue of 400. So we can record the product of 14,400, we can record the revenue of 400, but we cannot record the revenue of remaining 3 years, which would become 1200. Sorry. So this will become 1200. And out of this, 1 year is a current liability and remaining 2 years are a non-current liability. So the breakup is going to be 400 for the current and 800 for the non-current. Yes, Neeraj. So we should not be recognizing the revenue of this 400 and this 800. So we are going to prepare an entry to remove the revenue, and instead we will be calling this an unearned income. Smita, you can take the snapshot. So if I go back to the answer and I'm preparing the double entries over here, so I'm going to say in adjustment number 1, I will be debiting the revenue by 1200, and I'm going to record the unearned income as a current liability by 400 and unearned income as a non-current liability by 800. So this is the entry for the adjustment number 1. Are we clear with this? So this mainly related to the allocation of the transaction price and then the specific case of goods and services where the revenue for the services not yet delivered should not be recorded. Okay, now let's move back to the question. So adjustment number 1 done. Now let's discuss adjustment number 2. This also relates to IFRS 15. Smita wants me to explain again. Smita, actually we have given the product and the servicing, which was of 18,000 and 2,000, where we have given them at a discounted price of 16,000. Now this 16,000 includes the product of 14,400, which we can record as a revenue. And 1 year service has been passed by because the transaction was at the start of the year. So we can record the revenue for the first year, which is 400. But for the remaining 3 years, the services have not yet been delivered. So we cannot record the revenue for the remaining 3 years. So what is the revenue of 3 years? 1600 divided by 4, annual revenue of 400 into 3. So the revenue is of 1200 for 3 years, out of which 1 year is a current liability and remaining 2 years are the non-current liability. We haven't discussed yet contract asset, Ahmed Junaid. Is it clear, Smita? Okay, good enough. Now let's back to the question. Now the question further says in adjustment number 2 that the contract asset is comprised of contract cost incurred at 31st March 2016 of $15 million less a payment of $10 million from the customer. What is a contract asset? If we go onto the trial balance, we are going to find a contract asset in this, which is over here. So the contract asset is of 15,000. This is actually the revenue received from the customer and the cost paid by us. So this is basically construction contract, which we had not covered in the previous IFRS 15, but now using the example, we can cover a bit of that. So the question says that the agreed transaction price of the total contract is $30 million and the total expected cost is $24 million. And Downing Company uses an input method based on cost incurred to date relative to the total expected cost to determine the progress towards the completion. So if I write down the relevant values over here, the selling price that we have agreed is 30,000. The total estimated cost is actually 24,000. And the cost that we have incurred to date is actually 15,000. and the revenue that we have received is actually 10,000. So these are the four relevant values being provided in the question. So the first step is that we are going to calculate the percentage of completion, which is the cost to date of 15,000 divided by the total estimated cost of 24,000, which will give us the percentage of completion. So 15,000 divided by 24,000 into 100. The project has been completed 62.5%. Thank you, Simeon. So 62.5% is the project completed. So the revenue that we are going to record is going to be 30,000, the sales price, transaction price, into 62.5%. And the cost is going to be 24,000 into 62.5%. So this is going to be 30,000 into 62.5%. This is going to be 30,000 into 62.5 divided by 100. So this is going to be 18,750. And thank you, Arslan. And the cost is going to be 24,000 into 62.5 divided by 100, which is back to 15,000. So the profit is going to be 3,750. This is the amount of profit that should be recorded. So in adjustment number 2, we are going to record the revenue of 18,750, cost of sales of 15,000, and the profit of 3,750. Now, if you prepare the double entry, Bilal Aslam, there is no difference between IAS 11 and IFRS 15 other than the name and the number. Apart from that, there is no difference. Profit recorded at the year end, Nazia Zubair? The profit that will be recorded at the year end? Hamza is saying, sir, we didn't add the estimated cost and the cost to date in demonstrator while in denominator while calculating the percentage of completion. Basically, Hamza, the total cost was given to you and the cost to complete was not given. So when the cost to complete is not given, in that case, you can divide by the total estimated cost. If the cost to complete would have been given, only then we could have done that. Shiza Salim is asking, how have you calculated the percentage? Explain again. Shiza, the percentage is pretty simple. Cost to date divided by the total cost is the percentage. Cost to date divided by the total cost is the percentage. Cost to date divided by total cost is the percentage. Now, if you prepare the double entry, do look at this carefully. This is something difficult. The entry of revenue is going to be receivable debit, in fact, bank debit. Revenue credit. Okay. Disadvantages of technology. Sometimes it runs on its own. Okay, yes, now we are at the right place. So the revenue will be recorded by 18,000, 18,750. And the cash that we have received is of 15,000. So the remaining 3,750 is the contract asset. The contract asset should be recorded at 3,750. And similarly, the entry to record the cost of sales is going to be cost of sales debit by 15,000. Okay, sorry, the cash that we have received from the customer is 10,000 actually. So the contract asset is 8750. And the entry to record the cost of sales is going to be bank credit by 15,000, the amount that we have already paid, credit, and the cost of sales debit by 15,000. So this is the entry. This is the entry that should be prepared. Now what we will do is instead of bank, we are going to write the contract asset that the question has already given. Because the bank would have been recorded already in the contract asset. So the entry will become revenue credit contract asset debit and cost of sales debit contract asset credit. So if I make a net entry, I'm going to say the revenue should be credited by 18,750. The cost of sales should be debited by 15,000 and the contract asset should be debited by 3750. So this is a short entry and easier to learn. So it's better to follow this entry directly. Ahmed is asking that revenue of 18,750 is already included in the trial balance or not. How do I get to know this? Junaid, the revenue relating to the contract will never be recorded by the question. You have to record this on your own. You have to record this on your own always. So it will never be recorded in the trial balance on its own. So now this entry I'm going to post. Adjustment number 2. Contract asset debit by 3750. Cost of sales debit by 15,000 and revenue credit by 18,750. So this is the adjustment number 2 that was to be recorded in this case. If there's any confusion, you can ask. Smitha, UI is unearned income. UI is unearned income because when we are writing using a paper and pen, it will take comparatively more time to write the complete statement. Typing comparatively takes the less time. So normally when I'm typing, I write a complete sentence, and when I'm writing using a paper and pen, I follow the short forms. Yes, Ahmed, actually the bank has already been credited by the question. In every question, the bank will be recorded by the question. So we are supposed to record all other impacts other than the bank. Yes, Nazia, in the paper format, you can use the short forms, but try not to follow the short forms in the income statement and the balance sheet. For the double entries, for the workings, good enough. You can follow the short forms in the double entries and the workings. In the income statement and the balance sheet and the statement of change in equity, it's preferable to write the full forms. Neeraj, yes, in the balance sheet, the contract asset will go to current assets. Yes. Okay, now let's move back onto the question. Now we have covered 2 adjustments, moving towards the third. Are you people feeling it better on the paper format when I'm solving on the paper format, or on the CB format it was better? What do people think? When I'm solving on the paper and pen, is it better in that way? Okay, Faraz is saying CB was better. Sheikh Saqib is saying paper is better. Neeraj is saying paper is better. Aslan is saying both are good. Nazi is saying CB format is better, but I have opted for the paper. Lee is saying CB was easier to follow, and Shiza is saying paper based. Actually, yes, different people have different feedbacks on this, but the paper based exam is just going to end in December in Pakistan and other few regions. So whether you like it or not, you have to follow it. That's the rule of life. Simeon is also saying that I think CB was better, but paper is more appropriate for me. Okay, that's good. And Mohammad Ahab is saying none of the above. That's even better, Mohammad Ahab. Shiza is saying that she have opted for CB. No, paper-based exams. Okay. Okay, now let's solve adjustment number 3. The question says that Downing Company issued 300,000 $100 convertible loan notes, which makes it 30,000. Okay, so 300,000 into 100 is actually 30,000. On 1st April 2015, which was start of the year, the loan notes can be converted to equity shares on the basis of 25 shares for each $100 on 31st March 2008. So we have 3 years, year 1 to 3, or redeemed at par for cash on the same date, so they can even be redeemed. An equivalent loan note without the conversion right would have required an interest of 8%. So this is the market rate. So what I'm doing, I'm using the discount factor of the question. Year 1 to 3 cash flow is going to be 5% of 30,000, which is 1,500 for year 1, 1,500 for year 2, 1,500 for year 3. So I'm going to get the present value of all these. For present value, I need the keyboard. So if I run the calculator, so 1,500 into 0.93 is going to give us 1,395, and then 1,500 into 0.86 is going to give us 1,290. And it's 1185. Thank you, Kuli. How can it be 1185? Okay, in year 3 it is actually 31,500, because in year 3 we are going to repay the loan as well. So 31,500 into 0.79 is going to be 24,885. So this is 24,885. So now if we calculate the total, it is going to be 24,885 plus 1,290 plus 1,395, which is 27,570. So this is the liability, and the remaining amount is going to be the equity. So 30,000 minus 27,570 is going to give us 2430. So this is how we have divided it between liability and equity, and then we have to prepare a table with year, brought down, interest expense. Year 1 brought down is going to be 27,570. Then we have interest expense. Then we have interest paid, amortization, and carried down. So interest expense will be calculated using the 8% discount factor. So 27,570 into 8% is going to be 2205.4. Sorry, 0.6. And the interest paid is actually 1,500. So the difference is going to be 705.6. And then the carried down is going to be plus 27,570, which is 28,275. So we can actually round off the 0.6 to 1. So we can say 706. So I'm writing is 2206, 706, and 28276. Rounded off values. So now if I go and look at the trial balance would be showing the entire 30,000 in the liability, which would be incorrect. So the 5% loan notes have the entire 30,000 being shown as the liability. So my first entry for adjustment number 3 is going to be loan notes debit and equity option credit. And the second entry is going to be finance cost debit, interest paid credit, which we have taken from the trial balance, and the loan notes being credited. So if I go and see the amount of the entries, it is going to be 2430 for the first entry and 2206. So 2430 and 2206 with 1500 being paid and remaining 706 as a liability. So this was adjustment number 3, which we have seen in all 3 entries. So you people would be aware now of how to solve the convertible loan notes in the exam. Any confusions in adjustment number 3? Now let's see adjustment number 4. In adjustment number 4, the question says that due to rising property prices, Downing Company decided to revalue its land and building on 1st April 2015. We have decided to revalue at the start. So first we are going to revalue and then we are going to depreciate to their market value. The values which were confirmed at that date as land 16 million and building 52.2 million. So we have to see the values of the land and building. With the building having estimated remaining life of 18 years at the date of revaluation, Downing Company intends to make a transfer from revaluation surplus to retained earning. So we will be making another entry, revaluation reserve debit, retained earning credit. In respect of annual realization of the revaluation surplus, ignore deferred tax on the revaluation. Nabil is saying, so you said earlier that we are going to pay the difference at the end, but where we act then in accounting. Basically, yes, Nabil, we do pay the difference of the interest at the end, but at the end of the loan notes, which is at the end of the maturity, which means at the time of redemption, which means year 3 end. So we are accounting for year 1. That's why we are not looking at the amount that we are paying back. Okay, now let me see the values in the trial balance, and I'm going to check the net book value of these, the cost, the depreciation, and the net book value, and then the fair value, and then the gain. So if I move towards the trial balance to see the cost and the depreciation, the cost is land and building at cost 1464. So 14 for land, 50 for the building, and the depreciation for the building is 5,000. So the land has a cost of 14,000, the building has a cost of 50,000. So total is 64. The building has been depreciated by 8. So the net book value is 42. And the fair value given by the question is actually 16 for land, which will give 2,000 of revaluation gain, and 52,200, which gives the land being revalued by 10,200. So the total revaluation is 12,200 in this case. So the entry is going to be adjustment number 4, property debit by 12,200 and revaluation reserve through OCI credit by 12,200. And then we are also going to transfer the excess depreciation And we are also going to charge the depreciation, so cost of sales debit, property credit, and the plant credit. So if I move back and I see the new depreciation is going to be charged on the building, which is 52,200 divided by 18 years. This is going to be the depreciation. 52,200 divided by 18 years is going to be 2,900. So the building will now be depreciated by 2,900. Okay, Smita, actually in adjustment 4, we have first taken the cost and the depreciation to identify the net book value of land and building. We have calculated these from the trial balance. And then the fair values were given in the adjustment. So we have calculated the gain as 2,000 for the land and 10,200 for the building. So we have recorded the gain of 12,200. And then we have depreciated the building on the new fair value of 52,200. Am I saying earnings, the difference between old debt and regulated, right? Yes, exactly. Yes, Ahmed, both of your statements are right. So now we are going to charge the depreciation and cost of sales of the property at 2,900. And the third impact that we want is the transfer of the revaluation reserve to retained earning. So how do we do that? If I calculate the old depreciation, this will be net book value of 42,000 divided by 18 years. Because 18 years is the remaining life, so I'm using net book value. If it would have been the total life, I would have used the cost. So this is going to be 42,000 divided by 18 years. Okay. And if I do it like this, okay, yes, the answer is in decimals. So 42,000 divided by 18 will give us 2,333. This was the old depreciation. Minus 2,900 will give us the transfer, which is going to be 567. So this is the amount of transfer that we are going to do. So revaluation reserve debit and retained earnings credit by 567. So this was your adjustment number 4. Ahmed is saying that won't we divide old cost with the total life of the building? Ahmed, do you know the total life of the building? Ahmed, do you know the total life of the building? What was that? No, so we don't have the option. So when the question has specified the remaining life, we will divide net book value divided by the remaining life. And if the question would have given the total life, then we would have divided the cost divided by total life. So we have to calculate the old depreciation according to the information given. We have to calculate the old depreciation according to the information that has been given. Bilal, it's more or less the same. Welcome, Ahmed. Okay, now let's get back to the question. So now we have completed the revaluation of the property, its depreciation, its excess depreciation, all done. Now the question further says that the plant and equipment is depreciated at 15% per annum using the reducing balance method. So let's check from the trial balance. The plant is at cost of 82,700 and the depreciation is 36,700. So 82,700 minus 36,700 into 15% will give us the depreciation, which is 6,900. Yes, Samin, you can do it that way as well. So the depreciation for the plant is actually 6,900, which will make a total of 9,800 of the depreciation being charged to cost of sales. Okay, Cooley saying, thought we could divide the accumulated depreciation to arrive at the cost. Yes, Cooley, you can do it that way, but that is a more longer method, that you use the accumulated depreciation to calculate the age, and then you add in the remaining life to calculate the total cost, and then divide the cost divided by the total life. That is something very much difficult and a lot of chances to make an error. So when you have a simpler way, then why to get into more complications? So there is no need to get into complications, but although you can do that way, if you like it that way, go for it. Okay, now there is one more adjustment in the adjustment number 4, one more area. Where the question further says that during the current year, the income from royalties relating to the patent had declined considerably, and the directors are concerned that the value of the patent may be impaired. Now the question is going towards IS 36. A study at the year end concluded that the present value of the future estimated net cash flows from the patent is 3.25 million. So this is the value in use, present value of all future cash flows. However, Downing Company has also confirmed offer of 3.4 million to sell the patent immediately at that date. So this is the fair value less cost to sell. So with the recoverable amount is going to be the higher one, which is fair value less cost to sell. This is the recoverable amount. Now, if I go into the trial balance and look at the patent, so the patent was at cost of 7,500 and the life was 10 years. So first we are going to charge the amortization, 7,500 divided by 10 years, which is of 750. So the amortization would become total 3,750, and the net book value will become 7,500 minus 3,750, which is again 3,750. So first we have charged the amortization for the year. First we have charged the amortization for the year using 10 years life of 750. Now we have got the net book value, and the recoverable amount we have calculated is 3,400. So the impairment loss is actually 350. So the impairment loss is 350. The net book value is 3,750 minus recoverable amount of 3,400. So now the total amount is going to be 350 and 750. That is 1,100. So I'm going to amortize by 750 and impair by 350. So both the values I'm recording together. In the entry I'm writing is cost of sales debit and the patent credit by 1,100, because amortization will also reduce the patent and impairment will also reduce the patent. So I've made a combined entry. If that is confusing you, prepare entries separately. So 350 of impairment and 750 of amortization, I've recorded them all together. Shiza is asking, will finance cost go in liability too? Yes, yes, Shiza, the amount that we have not paid. The amount that we have not paid, which was of 706. This will go in the liabilities, nothing else. Is adjustment 4 clear to you people? Or you have any question? Okay, clear, good. Now let's move on to the adjustment number 5, which is the last adjustment, which relates to tax and the most easiest one. But the question says that the directors estimate a provision for income tax for the year to 31st March 2016 at $11.4 million. So if I write the entry, I'm going to say tax expense debit and provision for tax credit by 11,400. Back to the question. The question further says that the balance on the current tax in the trial balance represents the under-over provision of the tax liability for the previous year. So that current tax will be eliminated, moving upwards to see the current amount of the current tax. So the amount of the current tax, let's find it out over here, 1550 on the debit side. So I'm going to credit this current tax. I've taken this from the trial balance, 1550. And now again back to the question. Let me check the deferred tax brought down as well so that I don't need to come back again. The deferred tax brought down is 4800. So let's see the question. Now the question says that Downing Company had a taxable temporary difference of 18.5 requiring a provision for deferred tax. So the deferred tax liability brought down was 4800, and now we are going to calculate the carried down, and the movement will be taken to P&L. So the carried down is 18,500 into the tax rate of 20%. So this is going to be 3,700, I think. 18,500 into 20 divided by 100, 3,700. So this means that the deferred tax liability is decreasing by 1,000, not 1,000, 1,100. Yes, so 1,100 will be debited for deferred tax liability. And then the balancing figure will go to tax expense. So 11,400 plus 1550 minus 1,100 is going to be 11,850. So the current tax will not go anywhere further. This is something taken from the trial balance. Now we are done with all of the adjustments. So the remaining impact is now the P&L, the SOCI, and the balance sheet. The remaining impact is P&L, SOCI, and the balance sheet. Can you people try the remaining question on your own? We are already 15 minutes above the target. Okay, yes, a lot of yes, that's good. Shiza is saying provision will go in liabilities. Yes, Shiza, provision for tax will go into the current liabilities. Okay, that's good. So it will be more beneficial for you people to complete the remaining part and to see how much have you learned and what else will be required. So I would suggest if you solve these 3 questions multiple times, you would be able to attempt most of the part of the question of the final accounts in the upcoming paper. So any questions so far you people can ask? We have now completed all of the 3 questions. We have done triage, we have done extol, we have done Downing, and that's all for today. Lee saying great practice, concepts are much clearer. Thanks again. Thank you so much, Lee. Jazakallah to all. Neeraj, thank you. So quick feedback, 2 minutes feedback from you people. And specifically for the CB, how useful the CB question solving was for you people. How good was the CB experience, because this is the upcoming time of the fundamental level. So was it useful of solving some of the questions in the CB format? Okay, that's good enough. Thank you, everyone. Thank you so much. And thank you for the session. Hope to see you tomorrow. Thank you, everyone. Take care and Allah Hafiz.